Hi, I'm Chris Cook with FLG Partners, and we're excited to be hosting today's panel discussion on banking during COVID-19. I'll be moderating today's session along with my fellow FLG partner, Eric Hall. We have a powerhouse panel of experts from the Bay Area banking community, and they have valuable insights into how the banking industry will change as a result of COVID-19. Our first panelist, Robert Coleman, is an attorney and a CPA and the regional accountant of the FDIC for the San Francisco region. He has extensive experience as a bank examiner, and now he's training and consulting with bank examiners, bankers, CPA firms, Washington, and regional FDIC staff. Mark Cadieux is Chief Credit Officer at Silicon Valley Bank. He is responsible for establishing and maintaining the bank's credit policy and related processes and overseeing all credit, underwriting, loan approval, and portfolio management activities. We also have Dan Myers with us today, who's the founder and CEO of Bridge Bank, a $7 billion division of Western Alliance Bancorp, which is a $30 billion diversified business bank headquartered in Phoenix. Jeff Wishner is a well-known name in the investment banking community. He's managing director of Keefe, Bruyette, and Woods. He has deep experience advising West Coast banks, thrifts, and financial institutions on mergers and acquisitions and capital raising transactions. And also with us today, we have Derek Criswell, partner at Moss Adams, where he is the regional banking industry group leader of the Northern California Financial Services Group and is the lead audit partner for financial institution and SEC reporting company audits. So thank you all for joining us today. We're going to center today's discussion around some essential themes and questions, including what impact will be felt related to lending and other aspects of banking. We're going to be discussing the CARES Act, PPP, and forgiveness, and find out how pending changes to the accounting for loan losses may be exacerbated by the impact of this pandemic. And finally, we're going to hear our panelists' predictions on what the future holds in store for recovery. Now, the format is going to be an open discussion, and we're going to be sure to save some time at the end for your questions. So let's get started. So clearly, this pandemic is going to result in some changes to banking, and some of them will be more immediate, others may be lasting. So to the panelists, what are your thoughts on how the pandemic will affect banking in the near term and in the future? Do you see permanent changes in how we physically interact with banks? Or will there possibly be fewer branches? Dan, can you start off giving us your thoughts?
Sure, thank you, Chris. First of all, good morning to everybody, and I hope you're doing well through these unique times. Yeah, there are going to be some changes for our industry, both near term and intermediate. Long term, who knows, that'll play out. But as we all come to appreciate, everything is contactless now, right? So what we're going to see is long-standing trends of customers, particularly businesses, taking advantage of electronic delivery channels. So, that'll include more use of online banking, ACH payment streams, electronic signatures of docs, and things of that kind. Now, there is an embedded challenge in all of that, and that is that, what banks and what customers say they value the most, which is a close personal working relationship, we're going to have to work that one out because, doing things virtually has its limitations. So there's a challenge there for all of us.
Great, thank you. Did anyone else want to jump in? Perhaps?
I think Dan covered it.
Yeah. Okay, great. Well then, let's move on to credit standards. I think there's a lot of people in our audience that might be interested to know whether or not banks will be tightening credit standards overall. What do you see, Mark?
I'd say broadly speaking, probably yes. But I think the question is for how long and to what degree, right? I think it's probably going to be a different answer for different sectors of the economy, different segments of banks, businesses. And then within those segments, I think it'll be different answers for individual borrowers. Will probably be on a spectrum. And then I think the question nobody can answer is that how long part. I think right now, given all the uncertainty, it's really more difficult, frankly, for banks and lenders of all stripes to assess the degree of credit risk they're taking in originating a new loan, but that won't be true forever. I think clarity will probably start to emerge. And with that, I think clarity on what that credit risk is, and that probably has a effect on banks' credit risk appetite.
Right. There's definitely uncertainty on the credit risk side, and some companies are struggling. How do you see requests for payment deferrals, from these struggling companies during these tough times? How do you see them getting handled? How are banks working with their customers to help them through these times? Dan, can you chime in?
Sure. So the focus of conversations among business managers, and I guess to a large extent even individuals out there in this kind of environment, is cash, cash, cash. Okay, if you're a CNI company, if you're tech, you call it runway, but the concept is the same. You want to bridge the trough, and everybody's trough, it's a little different, but you want to get to the other end. So, the focus is, as the trade saying says, hope for the best, but plan for the worst. So the immediate conversation comes forward two ways. One is kind of an automatic deferral. Just give me 3 months or 6 months, and then, it gives me time to work out the longer plan. The second variation, and this is what we tend to favor within Bridge, is more of a focus on the intermediate and long term, and that's a realistic, thoughtful discussion of the challenges in the longer view. How am I going to get there? And that's a plan A, a plan B, and sometimes a plan C. Because as Mark said earlier, the uncertainty is very high. I've never seen it higher. And so one plan may or may not do it. So be prepared at multiple levels, figure it out before you have to get there.
Mm-hmm.
I'll just pile on. Our approach was similar in that it had elements of both of the things Dan's talking about. We were pretty early to roll out a programmatic deferral offer we bank a lot of pre-profit companies at SVB. And so we guessed correctly, there would be a lot of immediate demand, as Dan notes, to defer loan payments and preserve cash and extend that runway. And similarly, we expected, and we're right, that we'd get a lot of demand on companies that suddenly had become pre-profit and we're looking to defer that. So we rolled that out early. We did it for free. We did it with basically no questions asked up front, kind of a programmatic offer. And what that really also enabled us to do was then, because of where we targeted it, which was to the smaller and SVB only end of the spectrum, it then freed up capacity for us to engage with our clients who have larger credit facilities, more complicated credit facilities, to work through those issues. And the hope, of course, is all this runway, that deferrals, expense cuts, et cetera, is going to enable companies to get to a better place where more and better outcomes are possible, recognizing, of course, that it still remains to be seen whether that better place is really out there yet or not.
Mm-hmm. Yeah. So with this heightened level of risk held by banks that Dan and Mark referred to, due in part to this shorter cash runway, how do you think that this will affect regulators and how they assess a bank's safety and soundness? Perhaps our representative from the FDIC, Robert, can chime in on this one.
So we planned, our safety and soundness exams are not going to rate, we're not going to apply a different standard to the CAMELS components, but because of the pandemic, we're not going to be going on site to do our bank exams. We're going to do all of the bank examination remotely. And banks that cannot or don't have imaging or other technology, we're going to put those exams at abeyance. We keep track of all that. And in addition, when we're rating the CAMELS components, we will, if we can't rate the particular component, we will put that also in abeyance, but we will then do exit meetings and all those contacts electronically. So we don't plan to send any examiners on site to do our bank exams, although we are still maintaining our schedule to the best of our ability. So if your exam is coming up, your EIC will call you and talk to you, but don't expect any examiners to come on site. So that's kind of how we're handling it. same standards apply, but it'll just be remote exams.
Chris, I wanted to chime in as well. You know, from the external audit perspective, we're envisioning, similar to Robert, doing a lot of work offsite and trying to do the best we can to get that work done. From an audit perspective, though, the increased risk from the pandemic definitely will have an impact and make these 2020 audits a little bit more challenging. Credit quality and economic conditions have been pretty favorable the past few years, but that obviously has changed. And so the focus will be on credit quality as well as asset impairments. Regarding credit quality, additional efforts going to be expected on risk grading loans, TDRs, and then of course evaluating the sufficiency and appropriateness of those Q&E reserves. Asset impairments, we're seeing goodwill impairment be a big issue here in 2020 that really hasn't surfaced in the most recent years. And then depending on the severity and duration of the impact of the pandemic and the economy, and then the related loan losses that are sustained, the realizability of deferred tax assets could also be called into question. And so the accumulation of those factors will need to be considered by management teams as they're preparing their year-end going concern analysis. So a lot of headwinds facing banks this year that are going to have a little extra audit effort required.
Agreed. Very good point. And just pivoting a little bit, I mean, while there are certain companies that are struggling, there are some that are really looking to grow even in this environment. So how do emerging companies obtain financing for growth if there's a tighter credit environment? You know, are the capital markets open? Jeff, can you give us your perspective?
Sure. And I think a lot of this has to do with what Dan was talking about earlier, which is companies needing kind of liquidity. And I think this time around, as opposed to the Great Recession, you know, I think the government has done a terrific job of being very proactive. You know, it might have been a little frustrating during the PPP process, and we'll be talking about that later. But the fact is that they did provide support here, and continuing to provide support, which has been really helpful. I think what we see in the capital markets is that there was a little bit of a scary period, probably in the beginning of April, where maybe it was shut down for a lot of companies. But once these programs that were starting to roll out, you started to see liquidity liquidity go into the market. And so it's filtered itself all the way down to the private markets. And I'm sure Mark and Dan are seeing that from the venture capital community. And even like, it's amazing, Hertz, which, you know, filed for bankruptcy, is out with a common stock offering. I mean, I don't know how they're going to accomplish that, but the market is pretty optimistic. And so I think equity is open for certain types of sectors like technology and biotech, for instance. But I think the debt markets have been tremendously busy for all sorts of types of companies, and we'll talk about this later for the banking industry. So, but I guess I would kind of toss the ball to Mark or Dan to kind of comment on, you know, what they know best. They're very close to the venture capital community about how that market is functioning.
Yeah, I would agree with you, Jeff. There, you know, we've been in a market that's been awash in capital for a while, and I think that continues to be the case. We've seen in our portfolio of tech and innovation rounds of financing happening, you know, on a weekly basis. Maybe not exactly right on time. Might have been a delay of a couple of weeks to accommodate the inevitable conversation on valuation, but capital is available. If you look at the activity in venture investment in the first quarter of this year, it rose to the level of the average of the 8 previous quarters, which included the all-time record level of VC investment. So there is capital out there, a variety of capital too, which is to say every situation has a solution. You just got to find it. But there is activity happening.
Yeah, we just echo that. VCs I've talked to confirm that their pencils were down for about 3 weeks, and they got busy again. And to your point, I think in your question, Chris, about companies that are thriving in the age of COVID, and particularly for those that look like they're positioned to do that in the longer term, right? That it's not just a temporary COVID bump. Certainly, they'll have no problem accessing credit. We want that business, frankly, and are open and actively pursuing it. And I don't think we're alone there. We see plenty of competition already in the market competing for those best companies that appear the most durable.
So, right. So what we're hearing is there's certain companies that are thriving and they're going to be able to access the capital and the credit. But how do you view lending to industries that are affected by the shelter in place, like retail and restaurants? Are there any industries you foresee having a more difficult time obtaining or retaining credit? Mark, what are your thoughts on that?
Yeah, I think that maybe touches on my earlier answer. I think it will, to some degree, depend on the sector and then individual borrowers within those sectors as to how long and the degree to which access to credit is impacted. Certainly, there are some industries like travel and hospitality that are going to have some longer term impacts, and then some industries that may not exist anymore based on the sea change that I think is going to happen as a function of all that we've learned in the age of COVID and how consumer habits and preferences are going to change, et cetera. And so for us, that's certainly an area of focus. At the same time, we don't have a lot of the areas that are being impacted the most, like energy or commercial real estate, for example. And so pass it to Dan and see what he would add or subtract to this.
Yeah, similar view. The only thing I'll add to that is, we typically classify our view on lending and lines of business that we're both in, which is technology. I think there's going to be more thought and effort put into looking through just the profile of an emerging technology business with venture capital backing to what industry do they serve and what's the impact to that company. And that's part of that, thoughtful conversation that I referenced earlier with respect to, the conversation about requests for deferrals.
Right. And so I think that will affect the commercial real estate portfolio as well, what you're talking about. Now, some businesses will come back, others won't. There will be some foreclosures. Robert, can you tell us, do you anticipate an uptick in bank failures or any consolidation in the industry?
Well, the last couple of years have been the banks have accumulated a lot of capital. Last year we had just a few failures. Year before, I don't think we had any. And with the pandemic, although the banks have taken a lot of hits because of the pandemic and the quarterly earnings haven't been very good, I think in the future, we're just going to have to see about how that goes. There's a pretty good capital cushion right now overall, but we're just going to have to see how this all goes. So, and if anybody else wants to weigh in on that.
Chris, I'll take a view on here and basically, unlike the great financial crisis, which saw a lot of bank failures, we at KBW don't see a huge amount of bank failures in the industry. I think capital for the industry at 88-year highs. So you go back almost 90 years and you haven't seen this much capital cushion in the industry. Right now, tangible common equity to tangible assets is for the industry is at 9.6%. That looks a lot different than when we were in 2007 when tangible common equity to tangible assets was 6.6%. Also, just going back to the other question about kind of like high risk loans, I think our analysts are focused, research analysts are focused on that because investors are focused on that. And the high-risk loan categories are like hotel, restaurant, retail, energy, and CLOs, leverage lending. So if we kind of aggregate a lot of those kind of high-risk loans and compare it to capital, the median of our research universe, which is community and regional banks, is about 14%. And even in those categories, the high 14% of capital. And even if we look at the highest one of those, it's 44%. So, you have to really see a huge amount of credit loss to really kind of get to the bank failure. And with all that capital, we really just don't see it.
Yeah, the comments I'll add to that, and it sounds kind of cold, but in my 38 years in the business, through a number of cycles, it's the stronger, well-managed banks that survive and thrive, and it's the weaker banks that aren't going to do so well and ultimately have to consider their strategic alternatives. I think the stronger banks are, as they typically do in a down cycle, they're thinking ahead of the curve. They're moving to do things like supplement capital. I know Mark's bank recently had a supplement to capital, and we did as well. So it's it's hyper capitalizing, if you want to call it that, just to prepare for the what if. And I think you're going to see more of that as we go through the cycle.
As to the consolidation part of that question, we haven't seen a lot of M&A activity, not that many applications, but we are seeing some de novo applications. So we continue to receive de novo from applications from community banks and fintech. So that hasn't slowed down, at least from our perspective.
And Jeff, are you seeing any banks talking about M&A deals that might be brewing now? Perhaps small, medium-sized banks being acquired by the money center banks?
Well, we definitely aren't seeing money center banks looking at M&A. You have to remember that the money center banks are subject to a 10% national deposit cap. And I think, if we look at where money center banks have been successful, they've been very successful in attracting deposits from the digital channels, and have kind of been moving away from branch structures. And I don't think we're going to see any activity from the money center banks, but you go down a level to community and regional banks, and we're still have the same sort of trends that we had prior. And as a matter of fact, some of those trends may accelerate out once we're beyond this current crisis. We had a lot of conversations going on in kind of the regional size banks, looking at trying to leverage technology by combining. So we saw a lot of merger of equals last year, and some of those conversations that were going on right around March kind of fell apart. You asked, are there any M&A deals brewing right now? There are a few that I'm working on that took a pause in April, but are kind of coming back, thinking let's go back and for select situations. I think. But most people are kind of taking a pause and saying, look, we got to get our hands around credit. And if we're not comfortable with our own credit, how are we going to get comfortable with someone else's credit? And so I think that's the challenge. And so there'll still be bank M&A after this is done, though. It's a very tough operating environment. So.
Yeah, great. Well, thank you. We're going to pivot a little bit and talk about PPP and the CARES Act. And as we know, PPP is occupying much of the bank's lending capacity for several institutions. There are some banks that I've spoken to that said that they have made double the number of loans that they typically make in 1 year during a 2-month period under the PPP program. So I just want to throw this out to the bankers that we have in the group. How was that experience for you, Dan?
Yeah, so first of all, let me comment on what PPP was and is. It was a very well-intentioned, absolutely needed effort that was, for expediency's sake, channeled through an administration and a product that was never meant to handle it, right? So that created huge logistical problems, not only for the banks, but also for customers, and left everybody with a kind of a so-so experience. Now, having said that, our bank's experience was, I would have to say, in that context, pretty good. We ended up making almost 5,000 loans, totaling $2 billion in that 3-4 week period. And we did that because we've got 35 years of lending experience with the SBA. So we had an appreciation for SOPs, the process, the detail that they look for, but fully appreciate that it created huge challenges for everybody, both banks and customers.
Take Dan's experience and then imagine you haven't made an SBA loan in 25 years. And that was our experience. We were actually amazed to learn that our license, so to speak, our approval with the SBA was actually still active, had quite a bit of dust on it, but we were able to dust that off and ultimately figure out how to stand up a process. And it was not easy, in particular, given that we just moved to work from home, shelter in place. This comes along, the rules keep changing. And then of course, on a, with very short notice, it's okay, next morning, go. And so, so we had some fits and starts, no doubt, getting this thing off the ground. Like Dan, we ended up, I guess at the time of our earnings release, we had approved 3,600 applications, $2.2 billion worth of loans at that point. And so now, of course, we got through it. Our clients, while not enjoying the experience, much like us bankers, ultimately we're happy in the end to get all of their loans. And now, of course, we're at the next milestone, right, which is the forgiveness exercise that in effect is getting underway now, and some recent new rules, of course, that make that perhaps better and easier for those borrowers. And we talk about that.
Yeah. Well, Derek, what are you seeing with your banking clients?
Definitely. Thank you, Chris. And I'd like to start by thanking Dan and Mark and really commend them and their organizations, as well as the rest of the banking community. I know you lenders were working all night in some regard to take advantage of this mad rush for cash and ultimately help your borrowers in the economy. So we really appreciate that. We, Chris, have been working with a lot of banks now going through the forgiveness process. Again, that's a challenge, and some of the challenges we're seeing and helping clients with, first and foremost, educating relationship managers and borrowers on what does and what does not qualify for forgiveness. You know, the rules are, I don't want to say they're complex, but they are confusing and they continue to change. And the onus is on the borrowers to prepare those forgiveness applications, but I know they're going to be leaning on the banks for advice and counsel there. The other big issue is generating the human capital resources needed to validate the borrower information. Banks still have a lot of reputational risk on the line for these borrowers and with the SBA, and so they want to make sure those audits are done properly. And then last but not least, we don't want to forget providing a high satisfaction client experience. This is really an opportunity for banks to make relationships stickier, arguably to go out and take on some new clients and get into some new markets and new opportunities. But Chris, those are the three major things that we're seeing and helping clients with.
Mm-hmm. And you mentioned forgiveness. You know, maybe Dan or Mark, if you could chime in a little bit to see if there's anything you have to add about what the borrowers and the banks need to keep in mind related to the PPP application as the window closes and any forgiveness.
Yeah, that's a very good point. You know, the main appeal for PPP was forgiveness, so-called free money. And so there is a defined process for the customer to apply for forgiveness. That's the emphasis that we make with our customers who participated in PPP. You have to apply, it's not automatic. And because it is a government program funded by taxpayers, it is going to be subject to review down the road somewhere. So adherence to those procedures is absolutely paramount. We're suggesting to our clients, don't read them once, don't read them twice, read them 3 times. And then have your accountant or your attorney read them too and check your work. I'm sure it'll work fine, but the details in the process are important. And if you have immediate forgiveness, bear in mind, that's not the end of it. The SBA has been very clear, and some members of Congress have too. They're going to do an enhanced review after the fact. Could be years down the road. So make sure you do it right. Make sure you keep your records, kind of a little bit like filing your taxes.
Very good. And then once the loans are forgiven, they'll be off of the bank's balance sheet. So Mark, do you expect that banks are going to open up lending back to the pre-COVID levels or shrink their balance sheets?
Well, I think that will depend on the bank, right? Making these PPP loans really didn't impact our capacity to originate new loans, and so I think again the answer to that will be bank specific. But certainly for some, I think getting that forgiveness and in effect getting that capacity back to lend will be important in getting back into the market. And then the other side of this coin is the amounts that are not forgiven, right? I think it likely that in many instances there will be some portion of these loans, the unforgiven, as we've begun calling them, that are going to be around for a while. And then the question, I think, that, the next question will be is for those who are still struggling, how many of those will ultimately go into default, and what will the next odyssey for banks be in terms of dealing with the SBA and collecting on guarantees, if that's where we wind up. And so this is going to be with us, I think, for a while to come, even post forgiveness.
Yeah, and I'll add to Mark's comments. I agree. It depends on the bank. I think the stronger banks are open for business and will continue to be. I think there's also going to be a broadening of focus for those banks that are open for business, not only on offering their traditional credit solutions, but ones that are right for the time. So examples of that would be asset-based lending, which is ideal for a company who's showing stress of the times in their financial profile. And then, of course, the government-sponsored events. We've also talked about PPP, but there's the EIDL loans through the SBA, and then there's this pending Main Street program that we continue to hear in development and hope will launch soon.
You're on mute.
Oh, did you miss that?
I'm mute here. Sorry about that. This is all really very interesting. Let's shift gears and discuss CECL and the accounting for loan modifications. The CARE Act encourages banks to be lenient on payment of principal, soften troubled debt restructurings, and other similar items. The bank will need to demonstrate safety and soundness in the regulatory exam. Robert, how do you see the banks reconciling these two objectives? On one hand, being lenient, on the other hand, still adhering to sound banking?
Well, from a regulatory perspective, because of the CARES Act, the FDIC, when we do an exam, we won't criticize any loans that are made in conjunction with COVID-19. So if the loan or the modification is related to COVID-19, examiners should not be criticizing the bank's transactions. So they also wouldn't be considered TDR because it negates the financial difficulty element of the TDR, two-pronged TDR requirement. So we would not expect examiners to look at those modifications and call them TDRs, or even modifications for that matter. The only requirement we have for the bankers is that they should document their process and keep that, so that when the examiners come in, they may look at that, but they should not be criticizing it.
Okay, Derek, what impact has COVID crisis had on loan modifications, bank balance sheets, and earnings from an audit perspective? Should investors and borrowers be worried, and are dividends safe?
Great question, Eric. Thank you. Robert pointed it out, but one of the bright spots of the CARES Act was really to encourage banks to work with borrowers to provide short-term modifications without any adverse financial reporting impact. And arguably, COVID-19 does present some financial difficulty. Robert touched on this, and the CARES Act really alleviates that burden. When you go back to ASC 310-40, in order to account for a modification as a TDR, lenders need to ask themselves first, is the borrower experiencing financial difficulty? And if so, has they provided a concession? If the answer to both is yes, it's a TDR. But again, the CARES Act suggests that any modifications that are made in direct response to COVID, provided the borrower was current at year end or under the interagency statement current as of the date of the modification, that modification is not a TDR. And so companies would continue to account for those loans as general performing loans as part of their ASC 450 reserve, and not necessarily as a troubled debt restructure. we're recommending to clients to retain the documentation to be able to protect themselves against an audit or a regulatory examination. There's a lot of volume of these modifications, and TDR accounting and reporting is pretty specific and has some ramifications. And so companies will want to retain that documentation there. The CARES Act doesn't necessarily provide a get out of jail free card on the non-accrual loan accounting. Companies will still need to utilize their accounting policies for that. And as we look at the balance sheet and P&L impacts, other than the allowance for loan loss, I talked about it before, it's the potential for goodwill impairment, valuation allowances against deferred taxes, and then of course the challenge of the lower yields on the unforgiven PPP loans. We haven't seen investors too concerned with provisioning in Q1, probably not expecting too much in Q2 just because provisioning is all across the board. The investor focus, what we've seen really is on the number of loans in a payment deferral status, the number of modifications that could be made. While those were made in good faith and the borrowers could come back, there still is risk, and those borrowers did need a modification, and so bankers will need to watch those as we get closer to year end.
Maybe I'll step in here just to talk about the dividends. I think there's been lots of focus. As a matter of fact, there was an article this morning with Elena McWilliams commenting on that, on dividend capacity. I think European banks have mostly pretty much cut their dividends, and there's been a little bit of political pressure on banks in the United States to kind of look at their dividend policies. So what's different about, as I mentioned before, earlier in this conversation, from the Great Recession when we did see a lot of dividend cuts, is that we have so much more capital. But I think dividends aren't just about capital; they're about earnings, and so there is a focus on payout ratio. And if you look at the first quarter, because of CECL implementation, which we'll get to in a minute, is a lot of banks did not earn their dividend in the first quarter, and I think it's a state by state kind of requirement about how, if a bank can pay out dividends based on, for instance, in California, 2 years of earnings. And if you kind of wipe that out with large provisions, or in some cases goodwill impairment, which has become a topic that we're doing a lot of calls on, that could affect your dividend capacity. So I don't think we're really out of the woods, but I think basically most people believe that we're in a better position here, and that the industry's better capitalized, payout ratios will increase, but not exceed 100% for more than a quarter or two. We're much better positioned.
If you're retained earnings because of a goodwill impairment, and you want to pay dividends, you have a negative or a retained earnings, then bankers will have to file an 18I application in order to pay a dividend. So if because of this first quarter reduction in earnings, if the bank had a large goodwill impairment and it drove the retained earnings negative, then the FDIC would expect an 18I application in order to pay a dividend. So, but I think that we are going to treat that pretty liberally, and because of the situation we're in with COVID. So I would expect those to be approved, but it's every case is different. But just want to add that.
Okay, the CARES Act has had an impact on the adoption of CECL, which came into effect in the first quarter this year. What impact will CECL have on a bank's capital, and will the CARES Act provide any relief for banks? Jeff, what do you think about this?
Eric, it could provide some relief. It was designed for that, but again, there's not going to be a get out of jail free card on that, and we'll talk about it. But the CARES Act definitely had an impact on CECL. Large accelerated filers were required to adopt CECL effective January 1st of the current year. And of course, CECL requires us to incorporate an expectation for lifetime expected credit losses. So inherently, CECL reserves are going to be greater than the incurred loss reserves. And that's further compounded in COVID-19 with the surge in unemployment, projections for lower levels of GDP. And so Section 404 of the CARES Act does provide optional temporary relief. But based on our discussions with the SEC, we understand that banks that have deferred CECL under the CARES Act will be required to retrospectively restate their year-to-date results when they adopt the ASU related to CECL to reflect the application of CECL as of the beginning of January 1st, 2020 for calendar year-end audits or calendar year-end companies. Quarterly results will then need to be recasted for 2020, starting in 2021, so that the information is comparable. And so while the burden of complying with CECL has been delayed in 2020, it's only temporarily been delayed, and the work will still need to be done. And with respect to capital, banks that adopt CECL can continue to use the 2019 ruling, which phases in that day one impact to reg capital over a 3-year period. But on March 31st, 2020, a new rule was approved to allow banking organizations that were subject to CECL in 2020 an option to delay the 2-year estimated impact of CECL on regulatory capital and then transition that in over a 3-year period. So really a 5-year delay. The rule was designed to help make an even playing field for those banks under an incurred loss model and those banks under a CECL model. And those banks under CECL won't need to calculate under incurred loss and CECL. They're going to use a 25% scaling factor to kind of calculate and estimate the impact on capital for incurred loss and CECL. So again, there's no get out of jail free card. Companies will still need to do it, but it does alleviate the burden in 2020.
I think it's really interesting to look at what happened in the first quarter, because the CARES Act did give companies an out, and a lot of banks over time have been really complaining about what CECL does, but I think a lot of people kind of focused on, we're going to have to implement this anyway at some point in time. And, with having to restate earnings and stuff like that's very messy. I'm not even sure banks really grasp that, because I think the ones that delayed it may have taken a different view if they had known that. So out of like 203 small and mid-cap banks under research at KBW, 58% adopted CECL. About 15% delayed CECL, and about 23% kind of got a free pass because they were either a small reporting company or emerging growth company. So what we saw was a perfect storm. I mean, basically, CECL was meant to front load losses onto the reserves, and what was supposed to be a benign event ended up being a kind of a watershed event for the industry. We saw reserves quickly built. Now, one thing that was interesting is that they didn't allow you to kind of do what was called day one accounting, which was kind of the measurement day was January 1st. And we didn't know about COVID at that time. So we couldn't go back and say, let's put everything in day one so that it doesn't run through the income statement. Well, what happened was, companies had to take huge provisions in what we call day two, which was because things had changed dramatically between January 1st and March 31st. And that hit the P&L of many banks. Now, what we found out was that investors really were encouraging that, because in the first quarter, earnings to investors really didn't matter, at least bottom line earnings. I think pre-tax, pre-provision earnings still matter, but what investors weren't going to be focused on, and actually applauded banks who kind of took a proactive approach of kind of front loading some of that. We believe the second quarter, we're going to see more of the same. And investors, again, we believe will look through that. They'll be more focused on what's happening on, like, underneath it on pre-tax, pre-provision earnings.
Well, are you seeing CECL and COVID-19 affecting banks' valuations? I mean, what about their ability to raise and retain capital? Will banks need to raise capital this time around? I know Bridge Bank and SVB have gone out and raised debt. Do we see this being a recurring event here in the second quarter and third quarter?
That goes back into the capital markets question that we talked about earlier, and the capital markets are definitely open for banks, but more so on the sub debt and preferred markets. And I think there's a lot of banks that are looking at it and saying, it wouldn't hurt to have some, what we're calling just in case capital. No one knows how we're going to come out of this in the end of the day. And memories aren't as short as they used to be. People remember what happened in the great financial recession back in 2008 and 2009. There was a time when banks couldn't raise capital, debt or preferred or equity, and it was pretty scary. And I think a lot of bankers thought, you know what, how come we didn't just pull the trigger before and raise capital? We're not seeing a lot of common equity raises because of where bank stocks are. And I think rightfully so, people are believing that this is kind of temporary, banks trading at book value. At some point, investors will go back to a price to earnings ratio, and price to tangible books will go up. But yeah, we are seeing a lot of activity in the sub debt market.
Yeah, Mark or Dan, what are you seeing at your banks? You know, feeling confident that you got enough capital?
Yeah, I think we came into this thinking about this will be my fourth downturn. I got there at the tail end of one coming out the early 90s, late 80s, early 90s. And I think relative to every downturn, certainly we've seen at SVB, we come into this one, the best capitalized, the most liquid, far and away, relative to prior ones. And so not really concerned that CECL provisioning, et cetera, is going to drive a need for capital. As mentioned earlier, we did have a recent capital action, but that was more about adding liquidity than it really was. It was a senior debt raise. And to, I think, Jeff's point, why not, right? Have that additional flexibility, particularly when the terms available were so advantageous. And so I don't think provisioning, at least for us, is going to drive more capital actions. But at the same time, to that earlier point of uncertainty, it's hard to tell what the future holds. As Jeff alluded to, we took a fairly massive provision in the first quarter, in part as a function of using the later forecasts in March and taking a blend of those that we thought reflected a more severe outlook. But having said that, if we see further deterioration in those forecasts in the second quarter, left unadjusted, right, no qualitative adjustment, that could drive more reserving. It might also reflect a peak, in which case, weirdly, that could drive some reserve release, again, unless you look at that and say, well, that doesn't make sense. And so I think kind of like we observed in the first quarter, while we didn't do this, I think the second quarter, as we learn more about how these models behave, and we compare the model losses to what actually makes sense, I think we'll probably see lenders compelled to make some qualitative adjustments to reconcile between those two, much like we saw in the initial quarter.
Sounds good. Well, we're in the fast money section of the presentation today. I'd like to take on a topic we know is great interest to all the members of our audience today. We have a poll that's on the likely trajectory and shape of the U.S. economic recovery. Will it be relatively quick or more drawn out and painful? Will it be a V-shaped recovery, a U-shaped recovery, or something else entirely? So the poll should have popped up to our attendees, so please answer the poll and we'll give you the results later. Now I'd like to ask our panelists to weigh in on our poll question. Dan, why don't you kick this off? What is your forecast of the U.S. economic recovery? Is it going to be relatively quick or more drawn out and painful? Will it be
well, my economic skills, take them for what they are, but my view is the downturn was so quick and so unprecedented in terms of depth and impact. Even if we have what's normally considered robust growth on a quarterly basis in terms of percentage, it's still going to take a while to get back to pre-COVID levels of activity. So I don't think it's going to be a V. I'll borrow the term from Jeff. Sorry, Jeff, I don't want to steal your thunder here, but kind of a swoosh kind of configuration is more of what I see.
And maybe I'll just kind of explain what the swoosh is, because it's something that that I think going into this this economic time in the beginning, everyone was kind of hoping and thinking that there would be a quick recovery out of this because we came in with such strong economic terms. So and that was the V-shaped curve. Everyone heard about that, and then everyone started talking about a U-shaped curve as we started getting into this. But a U-shaped curve keeps us at the bottom for quite a while, and depending on how wide that is. But I think more recently, people have been talking about something called the swoosh, like the Nike swoosh. And you basically have a strong downturn but then you start kind of slow growth coming out of it, and it's not consistent at the bottom, and it could kind of go up and down. So I think that is, and what you'll hear from everyone. I think that's kind of what we had discussed as panelists earlier, not on this when we were kind of prepping for it. So I think there's a feeling that we'll see things like positive economic recovery. I think the stock market thinks that we're in a V curve recovery here, because it's really interesting that the Dow's over 26,000. When something like yesterday comes out that retail sales were up 16% May over April. Well, remember, we were down 19% in April. Even if we look at year over year, we're still down about 6%. And so it's going to take a long time, as Dan mentioned, to get back to where we are. I'll also borrow from my head of research, Fred Cannon. He talks about a bear market. It's interesting. He says, stocks go down 50%, but then they recover 50%. And wow, everyone feels great, except that if you go up 50% after being down 50%, you're still down 25%. That's the kind of economy we're going to be in. And so I think it's going to be a long slog.
Mark, what do you think about the economy?
Yeah, I've been, my predicting skills are really bad. I've been believing the next economic downturn was around the corner for years now. And then suddenly, just when I thought 2020 was going to be another great year, suddenly it arrives in the most sudden and unexpected fashion, right? So I'm hesitant for these reasons to offer forecasts, but with the adoption of CECL, I'm now, of course, compelled to. And so I will use the same thought process we employed in setting our first quarter reserve. Like the rest of our panelists here, our belief is sharp downturn and a low and presumably somewhat bumpy and slow elongated recovery. So kind of a long U, or U-shaped recovery with some maybe little bumps in the bottom, perhaps reflective of what you tend to see at the end of pandemics, right? End of pandemics are generally messy, and I think with all we're seeing in the news, it seems likelier than not that we could see some regional shutdowns perhaps, or further shelter-in-place orders that again make this a longer and bumpier recovery.
Robert, let's put the government on the spot. What do you see the economy looking in the next few months or next year?
I have to concur with other panelists. I think it's going to be a drawn-out recovery. I think it's going to be more like you, but I like the swoosh idea too. And it could be a long, drawn-out affair, but I don't see a recovery anywhere in 2021. Probably will extend beyond that. That's I think where we are. And the pandemic, we may get a second wave, so that could even draw it out further.
Well, Derek, you're batting cleanup here. What do you think?
I'm an optimist, like many of the panelists. I believe the glass is always half full. Going into Q1 and reviewing the Form 10Qs, expected a V-shaped recovery due to the significant economic stimulus that's put in play. And then, of course, the pent-up demand. People want to get out and spend money. Shelter in place while we're safe has been challenging. So thought that would really help out. But with that said, and the current lack of focus on social distancing, the pending flu season, I could easily see us moving into a W recovery situation, or at least another dip and then get into the swoosh. But hoping things work out and the economy recovers as quickly as it can. But I think it just really depends on the severity and magnitude of the pandemic and the government's related response as we enter into the end of 2020.
Okay, well, we've got our poll results back, and it's looking at about 52% think it's going to be a slow, gradual improvement with reduced overall outlook compared to pre-COVID economic conditions, and then it's uneven, up and down, erratic path to improve economic conditions. So we think the next 50% think it's going to be a prolonged and very erratic return. Slow, gradual return to pre-COVID economics. 21% thought it was going to be again long, drawn out. Only 15% of you thought it was going to be a relatively quick rebound, a U-shape. Nobody said it's going to be a V-shaped recovery. Very interesting compared to what I heard last week at another conference. So look like it's going to be a long ride to get back to where we were. So buckle your seatbelts. It's going to be a lot of fun and quite bumpy. So with that, we have some time for some questions. I've got 2 here and a couple others as well. Please address PPP loan forgiveness for self-employed. You know, for Bridge Bank or SEB, are you seeing you know, a lot of self-employed PPP loans that you processed? And what will be the forgiveness for those?
Yeah, we have not at Bridge. I can't. I'll defer to Mark to see what his
Yeah,
experience.
same here. I wish I had a perspective to offer for this particular question. I am not familiar enough with the detail to know exactly how it's going to work for the self-employed. My apologies.
Eric, you know, at Moss Adams, I haven't been too involved on assisting borrowers on the forgiveness side, but we have several tax partners and other partners who are very proficient. And so if the person who had this question wants to reach out to me, I can get them connected with the right people and get them the right answers to their detailed questions.
Sounds good. Here's a second question here. Is with depressed with depressed common stock equity prices for banks and relaxation of some regulatory control rules, do you expect some private equity funds and other activist investors to take more aggressive stances towards banks and build up control positions?
Well, that's interesting because it has a lot of implications. Robert can talk about the bank holding company rules. We're seeing a little bit of that kind of reminiscent of the great financial crisis, where some funds, private equity funds that did very well coming out of that time period, see attractive valuations here at book value and less. And so, but again, the banking environment is so well capitalized, they may not need to really entertain the private equity channel for capital. That's usually something that is available when the public markets are shut. And right now, as I mentioned earlier, public markets are fairly open. I think things would have to get a lot worse here, but I think private equity shops are doing kind of like their early work here.
Well, great. That's about all the time we have for questions. Chris, I'll turn it back to you.
Yeah, we'll just wrap up. I think we're at time here. So I just want to say that on behalf of FLG Partners, I would really like to, once again, thank our panelists as well as our audience for joining us today. We're going to be sending out a feedback survey later this afternoon to all of you, and that's really to help guide us at FLG as we continue to offer these opportunities to inform and engage our clients and colleagues in the business community. So we hope that you will fill that out, and we hope that you'll join us again for future events in our FLG Leadership Series. Thank you so much. Have a great day.